Hi, this is Ankur. In this video, we'll discuss about the credit cycles. Well, bank lends to businesses and businesses are expected to return back the principal along with the interest rate. This is the credit cycle. However, this is not simple as it may sound because businesses default. So why would businesses default? This happens because banks do not lend to the right businesses. Why would banks lend to wrong businesses knowing that they would default? There is a reason for that. Let's understand what is that reason. So when the business environment is thriving, banks usually lower down their standards of lending. Due to that, the money goes to wrong businesses or bad businesses, and hence there is a default as the market conditions move from positive to negative. So this positive to negative scenario creates cycles, and these are called credit cycles. It's the central bank that makes decision on monetary policy that helps in managing these cycles. In a way, central bank has a mandate towards inflation, and inflation has a indirect impact on the profitability of the company. Hence, central bank decision on managing the inflation through interest rate scenario has an impact on impacting these cycles. How these cycles impact your portfolio? Well, that is the question we are concerned with, right? When the inflation is low, interest rate is low. As the inflation starts increasing, interest rates start increasing, and that hurts borrowing power of the businesses and also the profitability. In order to boost the business sentiments, RBI has to reduce the interest rate, and hence this inflation going up, going down, going up also creates the interest rate scenario, which is in the form of waves. How does these interest rate scenarios help in understanding whether you are making wise decision related to your investments or not? Let's look at that. Well, first of all, how do you know which side of interest rates you are? Well, look at the interest rate history. We are currently at the lowest interest rate cycle ever India has seen. So from here on, we expect interest rates to rise only. So that basically indicates the first is the debt scenario. So if the interest rates are expected to rise in the future, you do not make positions in long-term investments, long-term debt investments. So what you do is park your money in a short-term safe investment category, or even in credit investments that are bonds that are not AAA, they are AA, A or BBB kind of categories can also be invested, but only by the investor who is informed investor, knows how to read financial statements and make a wise decision around that. But do not invest in long-term debt instruments because they will see a decline in their prices as interest rates starts to increase. The second category is the equity category. In equity category, they are impacted by the interest rates too. As the interest rates are low, borrowing cost is low, and so is the cost of capital. For those who are students of finance will understand that cost of capital is used as a discount rate to discount future cash flows, and hence the value of the equity lowers down if the interest rate rise. So when the interest rate is low, equity is thriving, which is the current state. As the interest rates will start increasing, the cost of borrowing will increase, and hence equity value will decline. That does not mean that equity will not be lucrative at that time, as a segment of equity will not be, but specific equity investments may still be thriving. For example, if you are invested in high quality business that is generating a very high return on capital, any increase in interest rate will have an impact, but not a huge impact on the share price of that company. Third is the real estate cycle. In real estate, interest rates, when they are low, it's a good time to invest. When interest rates are high, not a good time to invest. This should also be linked with the rental yields. What are rental yields? Rent received divided by the value of the asset is the rental yield. You compare this number with, let's say, a simple SBI FD rate. If rental yield is more than SBI FD rate, this is short a time to invest in real estate. Otherwise, you need to be conservative. So there are two sides to look into this on the real estate side. One is the comparison of rental yield with the safe instrument. The other is comparing the interest rate scenario. Then you decide what stage you are in. Looks like at the real estate side, we might be at the increasing side. So it might be all right time to invest. A very good time would have been, say, a year back. The fourth category is gold. Well, gold is an international commodity driven by international events. So Russia, Ukraine will have an impact, pandemic will have an impact, any other global inflation will have an impact, but not so much what is happening in India. So as a category, if there is a global scare, and as all countries are interlinked nowadays, so central banks have to respond considering the global events. In the current scheme of things, I feel interest rate scenario is low. As far as equity will continue to do well, gold prices may not increase that much. However, if there is an international scare, gold prices may fluctuate. And as the equity markets will become more and more expensive, there would be a stage when the gold prices will start increasing. No one knows when that would be. That is something to look for. And when we say that is something to look for, where do you look for? Well, often you need to get cues from media, from newspaper, from your readings, where we are in terms of the cycle. So when the market is very euphoric, when the media is very euphoric, it is time to be very conservative, conscious. So, which is contrary to what the media wants you to know. But when the media is very pessimistic about a lot of things, economy in general, equity markets, every asset class, that is a very good time to invest and evaluate your position. In today's context, you have to apply these senses in terms of where we are, in terms of this interest rate cycle. That will actually help you make wise decisions. And as time progresses, this understanding of the cycles will have a huge bearing on the portfolio, and hence your understanding of these cycles will help you navigate the storm reasonably. The idea is to act at the right time. I hope you like the video. Thank you for watching.